Welcome back. This is the third lecture of module 2 of this course. In this lecture, we are covering adverse selection and insurance. Let's move to this lecture. Adverse selection. It is often seen that a person or an organization with a higher risk probability is more likely to seek for an insurance policy. And in this case, if the insurance companies fails to analyze the policyholder, the adverse selection might result in higher than expected loss level. So the insurance companies really need to be very careful to identify whether or not it is an adverse selection. If it is an adverse selection, they will have more chances of loss. That means the adverse selection will result in higher than expected loss levels. So the insurance company should take actions that will help them to minimize adverse selection, and these adverse selections can be controlled by careful underwriting. That means analyzing the applicants carefully, analyzing their characteristics, analyzing the selection and classification of the insurance applicants properly. Secondly, there should be also policy provision, such as for example, if it is a life insurance, in this case there should be a special clause with regard to suicide. That's all about this lecture. In our next lecture, we'll learn what are the difference between insurance and gambling.